Hello and welcome to FT Markets. Greek banks are not in the best of health. They were closed for much of the last month, and now the country's parliament has passed a Bank Recovery and Resolution Directive, which provides a framework for the ominous-sounding resolution of its banking sector. So what's going to happen next? To help me answer that question, I'm joined by Oliver Burrows, a banking analyst at CRT Capital. So Oliver, thanks very much for joining us. First of all, can you just explain to us exactly what the BRRD is?
Of course. So the Banking Recovery and Resolution Directive is a directive across the whole of the European Union, so it applies to all 28 member states. And Greece is really catching up by implementing these standard rules in Greece as they stand in most other countries.
At this stage, Oliver, you brought a chart in, if we could bring that up. Let's just go back to basics and see exactly who loses what when banks fail or are resolved.
Sure. I mean, this is sort of Credit 101. This is the creditor hierarchy. This is what people traditionally think about when they invest in a bank. So the people at the top are the senior secured or cover bonds. They're the people who would receive their money back first in case of an insolvency. And only once they've been completely paid out do you go down to the next level, so on and so on, with equity at the bottom and tier 1 debt, etc. So looking at the other direction, the losses are applied from the bottom. Now, under the BRRD as it stands today, these blue bits at the bottom, the debt and the equity, the subordinated debt and the equity is today bail-inable. That means that losses can be applied through the BIRD today. But from 2016, senior unsecured could also be bailed in.
And let's see on the next chart exactly what those losses are going to look like. So what's
well, I mean,
here?
what has changed with the BRRD, and people thinking about your recovery in a liquidation is probably misleading because banks don't often go bankrupt. Resolution is a different step which is much easier and earlier to implement to keep the banking system going, essentially, so that the essential parts of the economy keep going. And what that means is that the bottom of the pyramid that had a hierarchy before now effectively get treated the same. The tier 1, the tier 2 debt, as well as equity, pretty much get wiped out if there's serious trouble in the bank. The green section, senior unsecured, but also large corporate deposits and uninsured deposits would be next in line and treated in the same way. So there is actually a different hierarchy, essentially, under resolution than there is traditionally.
And let's move back to Greece, specifically to Greece. I mean, bondholders and corporate depositors are now more likely to take losses. How likely is this to happen in Greece?
Well, the problem with Greece is the amount of debt that is outstanding, both senior and subordinated, is actually quite minimal because, as you can see, this government-guaranteed senior debt of the Greek banks, which can't be bailed in because that doesn't make any sense. It's used to provide liquidity through the central bank. So that can't be bailed in. So the amount of debt that actually could be bailed in is minimal, which raises the stakes for the haircut on that debt that exists.
Right. And how many deposits are covered by the deposit guarantee scheme?
Well, I did bring a chart in on that as well. We know that the deposits have been reducing in Greece. It's headline news for many months now. The deposits are currently about 117, I believe, billion euros. That's the end of June data, which 13 billion of which is corporate deposits. Now, we don't know the exact breakdown of that, in as much as how much of those corporate deposits are from small and medium enterprises and under the 100,000 euro threshold, which is insured. And we also don't know what amount the other deposits are insured. However, on the next chart, I've got the data from the Hellenic Deposit Guarantee Scheme, which does show that at the end of last year, around 22% of the total deposits in Greece were uncovered or uninsured. Interestingly enough, the insured bit was about 118 billion, which is currently what the amount of outstanding deposits in Greece are. So I would assume, in that very rough sense, that there are currently no uninsured depositors in Greece.
And this makes it more likely that bondholders will take some losses?
Well, I assume it's very easy to come up with a scenario where all of the senior debt, equity and subordinated debt of Greek banks is bailed in to one extent or other. And that can mean a number of things. It can mean conversion into equity or debt or being written down, but it also raises the stake for insured depositors because, quite frankly, if there are no uninsured depositors to take the loss before them, then insured depositors may find themselves in a little bit of difficulty.
Okay, and very finally, Just to step back from Greece a little bit, we've got the BRRD being applied across all EU member states ahead of next year. How many investors do you think will be closely watching the Greek situation to see if any blueprints emerge for how senior bank debt is treated in the future?
People will always say that, oh, but Greece is different. But then the failure of all banks is different or is unique. Cyprus was different. SNS Real in the Netherlands was different. But what they have in common is this common set of rules which applies losses in an organised and a way that is known up front, which is easier to predict, hopefully easier to price for markets.
Thanks very much, Ollie. So there you have it. Whilst no one can say exactly who will lose what in Greece, the authorities now have tools to decide exactly how they resolve or clean up the country's banking sector. And this will have important implications for the way senior bank debt is treated elsewhere in Europe.